We can use CVP analysis to evaluate the trade-off between our fixed and variable costs. So we can see here that we have the option to choose between two machines that will complete the same operation with the same quality, but have different variable costs per unit and different total fixed costs per unit. We can look at the break-even analysis and help us find the level of sales, called the indifference point. So which alternative should be chosen? So we are using this analysis to determine which machine we should buy. We have the cost of machine A and the cost of machine B. So we're looking for what number of units does the cost not differ between machine A and machine B. And what we calculate is that at 2,000 units, there's an indifference point in the cost between machine A and machine B. We also can use our income taxes in CVP analysis. So we must usually include the income tax effect because that affects the amount of net profit on any given level of sales. So we're going to look at after-tax profits and pre-tax dollar equivalents for a given tax rate. So before, we were looking for the before tax profit of $48,000. Now, if we're saying that we want $48,000 to be our after-tax profit with a 20% income tax rate, what must our before tax profits be? So we take the desired after-tax profits of $48,000 and divide by 1 minus our tax rate. This tells us that our before tax profits need to be $60,000 in order to have a $48,000 after-tax profit. Therefore, when we're looking at taxes, our CVP model is as follows. We have fixed costs plus our after-tax profit divided by 1 minus our tax rate, and that full amount divided by our contribution margin per unit. So now we see that we need 3,000 units in sales in order to meet this after-tax profit of $48,000. We can also use CVP analysis with activity-based costing. If our assumption is made that total batch level costs are fixed relative to the number of batches, then both approaches are the same. Our CVP analysis volume-based versus activity-based. However, if our activity cost pool is a mixed cost, then activity-based costing is going to provide a more accurate estimate of cost because volume-based treats all activity costs that do not vary with output as fixed. So in our activity-based costing approach, we need additional information to define what portion is our fixed cost element. So we have some information here. So we have 60,000 in mixed cost. 50,000 of that do not vary with our activity cost driver, but 10,000 do. So the portion of fixed costs that do vary with our activity cost driver is $10,000. We then have our cost per batch for that activity driver and the number of units in a batch. So that gives us a cost per unit for batch-related cost when the batch is size B of $3.33 or $100 a batch divided by 30 units in a batch. Then when we're looking here for batch-related costs, we need to look at how many batches, what our batch costs are. So then that $100 divided by 30 becomes a variable cost. And our fixed cost reduced from 60,000 to 50,000. We can't do partial batches, so we have to do 90 batches. Remember, in CVP analysis, we round up for any number after a decimal point. So it does not follow normal math rounding. Because we have 89.1, we have to round up to 90 batches at $100 a batch. So that becomes our cost. That's the mixed cost component of it. So now our break even is 50,000 in fixed cost, 9,000 as that mixed component of a fixed cost, plus our hoped for profit of 48,000 divided by our contribution margin. This gives us a quantity of 2,675 units. Sensitivity analysis is this what-if analysis that looks at different changes to help us deal with our risk and uncertainty. So we can use what-if analysis using our contribution margin and contribution margin ratio. We can also look at decision tables, decision trees, or expected value analysis, or just do expected value analysis. When we're looking at sensitivity analysis, it looks what happens at different levels sold. So we have an example here of what-if analysis with our HFI example. So our variable cost per unit, our selling price per unit, and our total fixed cost per unit. So what we're looking at here is what would happen if our variable cost per unit changed. What happens if the cost of our direct materials or direct labor increases? For example, our units sold stay the same, our fixed costs stay the same, and our selling price stays the same. However, that change in variable cost affects our operating profit. So you can see that at $30 for variable cost, we would have a positive operating profit. At $35 variable cost, we would break even, and at $40 or $45 variable cost per unit, we would have losses. When we're looking at a decision table or decision tree, we're incorporating probabilities into the analysis. So we make this decision table, which is a set of our actions or various decisions, the events, and the outcomes. And then we look at the expected value of each decision alternative. So what's the likelihood or probability that any of these would occur? One of those metrics that we use for risk and uncertainty is margin of safety. Margin of safety is the amount of our actual sales, forecast or actual sales, that is above our break-even point. So our planned or actual sales minus break-even sales. The margin of safety ratio is the margin of safety divided by our planned or actual sales volume. This is the percentage or dollar amount that our sales can fall from our planned or actual levels before we start operating at a loss. Another way to look at risk and uncertainty is the degree of operating leverage, or DOL. So operating leverage looks at the extent of fixed costs in the cost structure of an organization. The greater our operating leverage, the greater our risk. So the higher our fixed costs, the higher risk we have of not being able to cover those fixed costs with our operations. The degree of operating leverage at any sales volume looks at the sensitivity of operating income to changes in sales volume. So the calculation of degree of operating leverage is contribution margin divided by our operating profit. In this example, we're looking at HFI data from the book for the year 2019 and quantity of 2,400 units. Our contribution margin at 2,400 units is $96,000. This is divided by our operating income of $36,000. This gives us a degree of leverage of 2.667. At this level of output, each percentage change in sales results in a 2.667 change in our operating income. It's very rare that an organization only has one product or service. When we have multiple products or services, we use a standard sales mix in our CVP analysis assumptions. We determine what the weighted average contribution margin per unit and the weighted average contribution margin ratio are to complete any multi-product CVP analysis. So looking at this example, we have a company that sells sports recreational jackets. We have 3 products. Our total joint fixed costs for the period are $168,000. We assume that our sales mix is going to remain constant. So we have additional information below. Since sales mix is constant, we look at the contribution margin ratio in the analysis. So we look at what the percentage of sales is for each product. So we have this ratio, 5 to 4 to 1. So for every 5 we also sell 4 Windy and 10 Gale. Then we also have the contribution margin ratio per product. So we have a 20% contribution margin ratio for Calm, 25% for Windy, and 10% for Gale. We take that percent of sales and its contribution margin ratio to come up with a weighted contribution margin. So we can see where we take the 50% times 0.2, or 20% contribution margin, plus the 40% sales percentage times 25% contribution margin, etc. And we come up with a 20% weighted average contribution margin. Therefore, our break-even point is $800,000 in sales. That's total sales. In order to determine what number of sales we need for each unit, then, we need to take that times their sales percentage for each unit. So if we have 800,000 total in sales, that is 50% Calm, 40% Windy, and 10% in Gale. That tells us how many units of each at our current projected sales mix we need to sell in order to hit a break-even sales amount. The assumptions and limitations of CVP analysis are, 1, that we always assume all of our revenues and costs are linear over a relevant range. We also look at if step costs are approximate via the relevant range, then the CVP analysis becomes much more cumbersome. Also, CVP analysis is difficult when we have mixed costs involved in our fixed costs. The basic model makes assumptions that our sales price and our variable costs remain constant, our fixed costs remain constant, and our sales mix remain constant. It is still a good tool. Even though we make a lot of assumptions about the tool, it's still a very good tool for making some short-term analysis decisions and seeing what various changes, short-term changes in our sales volume can affect our bottom line.